It is Saturday, May 3rd, 2025.
Great to be here.
And look, if you're anything like us, you've probably been trying to keep your head straight with all the twists and turns in Trump's tariff policies lately.
Oh, absolutely. It feels like it's changing almost daily.
Yeah, just since, late April? It feels like a constant stream of announcements, so many countries involved, markets reacting.
Yeah.
It's been a bit of a roller coaster.
It really has. A really dynamic situation. And, if you're looking to get a handle on the key movements, but without getting totally lost in the day-to-day noise, well, that's what we're trying to do today.
Exactly. We're going to try and pull out the crucial bits, make some sense of it all.
Yeah, distill it down. Hey, everybody, and welcome back to Sip and Talk.
Hey, you. So our mission for this first part of our deep dive is basically to get a clearer picture of where things actually stand with these tariffs right now. We'll look at the progress, I guess, of what some people are calling the trade war. And maybe even try to pinpoint some industries, here in the U.S. that might actually find a bit of an advantage in all this.
That's a good angle. And then for the second half later on, we know a lot of you are interested in the bigger economic picture.
Yeah.
So we'll be diving into what some of the big investment experts are saying about the economy's overall health. So definitely stick around for that.
Okay, good plan. So let's unpack this current tariff situation then. It really feels like things started heating up maybe around April 9th.
Yeah, that seems about right.
There was that announcement, something about a 90-day pause on reciprocal tariffs, they call them.
That's the one. Yeah, April 9th was pretty significant. This 90-day pause on reciprocal tariffs, basically, tariffs countries put on each other in response.
Tit for tat, sort.
Exactly. That applied to roughly 75 countries. China was notably excluded, and they mentioned this 10% baseline tariff as well.
Okay, so excluding China, a pause for many others. What was the thinking behind that initial move? It seemed like a bit of a step back.
Well, it looked like a reaction to quite a bit of volatility we were seeing in the global financial markets.
Ah, right. The Dow took a bit of a tumble then, didn't it?
It did, yeah. A noticeable drop. Plus, a whole lot of countries had apparently asked to negotiate, to talk things through.
Right. That market dip was hard to ignore. So it's kind of like hitting pause to let things calm down and maybe talk.
Pretty much, yeah. And it sounds like a lot of countries were keen to do just that.
Okay.
Reports suggested somewhere between 90 and 100 countries showed interest in negotiations.
Wow, that many.
Yeah. And by the end of April, the White House apparently had, I think, 18 formal written proposals and was actively talking with 34 countries.
So a lot happening behind the scenes. Who was leading those talks for the U.S.?
The key figures mentioned were Treasury Secretary Scott Bessent, Trade Advisor Peter Navarro, and Commerce Secretary Lighthizer.
Okay, the usual suspects, more or less. But it sounds like that 90-day pause might not last forever for everyone.
That's right. Just a couple of weeks later, around April 23rd, the administration indicated that those reciprocal tariffs, they could be back on the table.
Oh, already?
Yeah, possibly within 2 to 3 weeks, so looking at mid-May for any countries that hadn't reached some kind of agreement.
Okay, so the pressure's still on to negotiate.
Exactly. The specific rates weren't mentioned, just that they could, either replace the 10% baseline or maybe be a temporary thing. Keeps the incentive strong.
Right, okay. Now, things were quite different with China, though, weren't they? It sounds like tariffs there actually went up.
Yes, the China situation evolved quite differently. On that same day, April 9th, tariffs on Chinese goods jumped from, I think it was 104% up to 125%.
Whoa. 104 to 125.
Yeah. And then you have to add the existing 20% tariff related to fentanyl.
Right.
So combined, that pushed the rate on some goods up to a massive 145%.
145%. That's a huge jump. You have to think about what that does to the price of things coming in.
Precisely. And then fast forward to April 16th, the White House put out a statement saying that because of all these cumulative effects, some Chinese goods were actually facing tariffs as high as 245%.
245%. Good grief. That's an escalation, no doubt about it.
Definitely an escalation of the existing tensions.
But then, didn't the tone shift a little bit around maybe April 22nd? I thought I heard something about maybe softening that stance.
You did, yeah. There seemed to be a bit of acknowledgement that maybe 145% wasn't sustainable, long term.
Right.
Big retailers like Walmart and Target, they were apparently warning about pretty significant price hikes for consumers. maybe even shortages if those rates stayed that high.
Yeah, you can see why they'd be worried. Nobody wants empty shelves or, paying double for things. So what was the alternative that we're floating?
Well, on April 23rd, they mentioned possibly seeking a lower tariffs agreement with China.
Okay. Lower than 145, presumably.
Presumably, yes. And there's also talk about exploring a tiered tariff system.
Tiered? How would that work?
The idea, it seemed, was maybe having rates in the, say, 50% to 65% range, but potentially a lower rate, maybe 35%, for stuff not seen as a national security risk. And then maybe a much higher rate, like 100%, for things considered, core national interest.
Okay. So like different rates for different types of goods, a more targeted approach, maybe?
Seems like it, yeah. More strategic, perhaps.
So how did China react to all this? Tariffs going way up, then talk of maybe bringing them down a bit, but still high.
Well, China's response was pretty swift and, retaliatory.
Not surprising.
No, starting April 11th, they slapped 125% retaliatory tariffs on U.S. goods.
Ouch. Okay.
And they also filed a formal complaint with the World Trade Organization, the WTO.
Right. Arguing they violated international trade regulations. When a country files with the WTO, they're usually saying another member's policy breaks agreed rules, like treating all members equally on tariffs.
And what happens then? Does the WTO rule on it?
It can lead to a ruling against the U.S., maybe forcing them to change the tariffs, or it could just become a really long dispute process.
Okay. So they push back hard. Let's switch gears slightly to semiconductors. That's such a critical area, right, with all our tech.
Absolutely vital.
What happened with tariffs there?
Yeah, the semiconductor situation was pretty interesting. Around April 13th, there was an announcement saying tariff rates on imported semiconductors were coming soon, like within a week. The stated goal was, trying to get companies to bring production back to the U.S., reshoring.
Right.
But they also hinted there might be some flexibility, especially for things like smartphones and computers, acknowledging how complex those supply chains are.
Okay. And did that flexibility actually happen?
Yeah.
At least for a bit. It did, yeah, temporarily. On April 11th, Customs and Border Protection, CBP, announced a temporary exemption.
For which products?
Specifically smartphones, laptops, and memory chips. They were temporarily spared from both the big 125% China tariff and that 10% baseline.
Okay, so some breathing room for those specific things, but temporary, you said.
Yeah, Commerce Secretary Lighthizer made it clear these exemptions were, quote, temporary, expected to last maybe 1 to 2 months.
Got it. So just a short window. Now, what about other big players in chips like Taiwan? How did this affect them?
Yeah, this is where it gets a bit more nuanced for Taiwan. While semiconductors generally got that temporary pass, certain key Taiwanese exports to the U.S. did not.
Oh, like what? Specifically,
AI servers and components for graphics cards, big exports for Taiwan.
Right.
Those were not exempt and are apparently facing a potential tariff of 32%.
Ouch, 32%. That seems like it would hit some specific Taiwanese companies pretty hard.
Yeah, it could definitely have a noticeable impact on their manufacturers in those high-tech areas.
Yeah. Okay, so beyond China and chips, what other goods or industries got caught up in these recent tariff changes?
Well, we saw that 25% tariff on imported cars and auto parts kick in back on April 3rd.
Right, hitting Japan and South Korea particularly hard, I imagine.
Exactly. And then there's the 25% tariff on global steel and aluminum. That's been around since March 12th. And it's worth noting, steel exports from Taiwan didn't get an exemption there either. So companies like China Steel are feeling that.
Okay. Any exemptions besides the temporary tech ones?
Yes, actually. Certain goods that are apparently in short supply here in the U.S.
Like what?
Things like certain types of chips, again, copper, lumber, medicines, gold bullion, energy products, some minerals. Those got a temporary exemption from the 10% baseline tariff.
Okay, so it's a real patchwork quilt depending on the product and where it's from.
It really is. Very complex.
So what's been the broader reaction globally? We talked about China, but what about other countries?
Well, it's been pretty diverse and often quite assertive. China, as we said, hit back with 125% tariffs, sanctioned some U.S. military-industrial companies.
Right.
And they're actively trying to boost trade ties with the EU and South American countries, like the Mercosur group, trying to rely less on the U.S. market.
Playing the long game.
Seems like it. They even put out a propaganda video explaining their stance. And their economists are saying, yeah, exports might take a hit, but the long-term plan is boosting their own domestic demand.
Interesting strategy. What about our allies in Europe? How are they reacting?
The EU is facing that 20% reciprocal tariff. They had announced plans for 50% retaliatory tariffs on things like, U.S. whiskey.
Oh, yeah, I remember that.
But then, on April 9th, they also announced a 90-day pause on those to allow for negotiations.
Ah, okay, so they paused too.
Yeah, but they've been very clear. They're ready to push back against what they see as unreasonable trade barriers.
Right. And our neighbors, Canada and Mexico?
Well, goods traded under the USMCA, the replacement for NAFTA.
Yeah.
Those have indefinite exemptions. But anything not covered by USMCA faces the 25% tariffs. And Canada had already put its own 25% retaliatory tariffs on about $21 billion worth of U.S. goods back in March.
Okay, so even they're not totally shielded. What about Japan and South Korea, especially with those auto tariffs?
Japan's facing an overall tariff rate of about 24%.
Yeah.
And that 25% auto tariff is hitting them hard. It's apparently contributed to a pretty pessimistic economic outlook there.
Yeah, that.
South Korea, also facing 25%, they've started preliminary talks with the U.S. trying to, lessen the blow on their key industries.
Okay. And lastly, what about Taiwan's official response to all this, especially that hit on AI servers and graphics cards?
Yeah, the government in Taiwan definitely reacted. President Lai Ching-te called the U.S. tariffs unreasonable back on April 9th. And he told the premier to get information out quickly about how they were prepared. Then, on April 14th, their executive yuan approved a pretty big support package, NT $88 billion.
That's a lot.
Yeah, for their export supply chain. Things like export loan incentives, more loans for small and medium businesses. Application details are public.
So trying to cushion the blow domestically.
Exactly. And their administrative team is planning to come to the U.S. to negotiate. But, academics there are warning that if they can't kind of defuse this, Taiwan might not hit its forecast of 3% economic growth.
Wow. Okay. So it's a hugely complex web of actions, reactions, negotiations.
It really is.
These tariffs are sending major ripples everywhere. Okay, let's shift gears a bit. With all this disruption, this trade war footing, are there actually any industries within the U.S. that might, benefit from all this or from related tax stuff?
That's really a good question. And yeah, based on the research and analysis, there are definitely sectors that could potentially see some advantages.
Like who?
Manufacturing often comes up. Real estate, technology, though, that one's a bit more complex.
Oh.
These could potentially benefit from tax cuts that have been part of the discussion, like corporate rate reductions, investment incentives from the Tax Cuts and Jobs Act, the TCJA.
Right, the big tax law from a few years back.
Exactly. And then you've also got agriculture and maybe small businesses who could potentially benefit from, protective tariffs, reducing import competition, or from simplified tax rules.
Okay. But it sounds like there's some debate about how much they actually benefit.
Oh, definitely. It's debated, and a lot depends on the final details, which, as we know, can change.
Right. Okay, let's dig into manufacturing first. How could they potentially gain?
Well, think about it. If the corporate tax relief from the TCJA continues or gets extended, and you combine that with less competition from imports because of tariffs, well, that could mean lower tax bills and maybe lower overall costs for domestic manufacturers.
Especially for industries like steel and aluminum, maybe, where the tariffs are high?
Exactly. Steel, aluminum, maybe some consumer goods sectors. There was even research suggesting the original TCJA led to something like a 20% jump in domestic investment.
Wow.
So more tax relief could potentially boost that further, especially for manufacturers who don't rely too heavily on, specialized imported parts that are now more expensive.
That makes sense. Lower taxes, less foreign competition. Sounds like a potential win for some domestic players. What about real estate? How do they fit in?
Real estate could keep benefiting from a couple of things in the TCJA, mainly the pass-through deduction and opportunity zones.
Okay, refresh my memory on those.
Sure. The pass-through deduction, Section 199A, lets many developers and investors deduct like up to 20% of their business income, lowers their taxes.
Right.
And opportunity zones. Those are designed to get investment into low-income areas by giving tax breaks to people who invest capital there, maybe deferring or even wiping out capital gains taxes if they invest in these special funds.
Ah, okay. So those incentives could keep stimulating building and investment, especially in certain areas?
Exactly. They could continue to be a driver for development.
Interesting. Okay, now technology. You said that was more complex. Why? They use global supply chains so much, right?
Precisely. It's likely a real mixed bag for tech. On the plus side, they could benefit from things like R&D tax credits and being able to fully expense capital spending on equipment and software right away. That encourages innovation.
Okay, so incentives for growth.
Right. But the tariffs, they could seriously hike up costs for tech companies that depend on imported components, especially from China.
Yeah. So the tax breaks might help innovation, but the tariffs hurt the bottom line if you're importing parts.
That's the potential balancing act, yeah. Could offset some of the gains, especially for companies really embedded in those global supply chains.
Makes sense. Okay, what about agriculture? How might they benefit?
Well, potentially from tariffs on imported farm products. The idea there is usually, reduce the agricultural trade deficit and protect domestic producers.
Like for corn, soybeans, meat.
Yeah, those kinds of key commodities. Making imports more expensive theoretically makes the U.S.-grown stuff more competitive at home.
Okay. And lastly, small businesses. How could they see a boost?
They could benefit if simplified tax rules get extended and also from increased deduction limits, like Section 179.
Section 179, that's the one for expensing equipment purchases, right?
Exactly. It lets businesses deduct the full cost of qualifying stuff like equipment or software in the year they buy it, up to a pretty high limit, like $1 million or so.
Ah, okay. So that helps lower costs when they invest in their business. Could help small manufacturers, service providers, retailers.
That's the idea, yeah. Lower operating costs, lower tax burden.
And you mentioned energy briefly, too, both traditional and renewable.
Yeah. The energy sector could also benefit from that full capital expenditure expensing. Lets them deduct the full cost of big investments like drilling rigs or solar farms right away instead of over many years.
Improves cash flow, encourages more investment.
Right. Plus other related tax incentives for the sector.
Okay.
Yeah.
But it's really important to stress, right, that these are potential benefits. It's not all guaranteed. And there are potential downsides, too.
Absolutely critical to remember that. There's a lot of uncertainty. And look, critics argue these tax cuts might mainly help higher income folks and big corporations.
Mm-hmm.
And, as we've been saying all along, the tariffs themselves, they raise import costs. That could hurt sectors like tech and auto and, eventually hit consumers in the wallet.
Right. Costs often get passed along. Okay, so wrapping up this first part. It's clear this whole tariff situation is, incredibly fluid. So many countries, so many industries affected.
Oh, very dynamic.
And while some U.S. sectors, maybe manufacturing, real estate, maybe parts of ag and small business, might see some advantages from the tariffs and the tax policies, it's a really complicated picture.
Yeah, lots of potential downsides, lots still up in the air.
We are definitely going to keep tracking how this all plays out. But hey, don't go anywhere, because up next, we are diving into what the big investment names are saying about the economy overall. Stay with us. All right, welcome back. We just worked our way through the maze of Trump's latest tariff moves and looked at who might actually benefit here in the U.S.
Yeah, it really underscores just how tangled up the global economy is, doesn't it?
Yeah.
How these big national policies can ripple out and affect all of us, even just as consumers.
Let's jump right into it. Lately, if you've been glancing at any financial news, you've probably seen some pretty strong opinions flying around.
Oh, yeah. About what 2025 could look like for the economy.
Exactly. We're talking about some major players and, big institutions using phrases that definitely make you raise an eyebrow.
Things like worse than a recession.
Yeah, or expecting a significant correction. Stuff like that. So we're going to try and
see if anyone's pointing to maybe a brighter side.
Right. And ultimately figure out the key things we should understand without getting completely lost in the jargon.
Exactly. It can feel like a lot of noise out there when you hear these big predictions. Our goal isn't to say what will happen because, honestly, who really knows?
Nobody.
But to get a clear picture of the main concerns being voiced and maybe pull out some useful insights that you can think about.
Right. We've gone through statements from some of the biggest names in the investment world, like Ray Dalio, Steve Cohen, Ken Fisher, too.
And also reports from the International Monetary Fund, Deloitte. So institutional views as well.
So we've got a range of perspectives from individual takes to those broader institutional outlooks.
And what's fascinating right out the bat is how differently some of these, very experienced people see things. That alone tells you a lot about the uncertainty we're all facing, doesn't it?
It really does. Okay, so let's start with the folks who are sounding a more cautious note. Ray Dalio, founder of Bridgewater Associates, he's definitely in this camp.
Yes.
He's talking about the potential for something even worse than a recession. What are the main drivers of his concern? What's behind that?
Well, Dalio's worries seem to come down to a few interconnected areas. He's looking at ongoing disruptions in global trade, the increasing amount of debt the U.S. is carrying,
and the rise
of other global powers. His big fear, it seems, is that these things could lead to a breakdown of the global monetary system.
A breakdown.
Potentially even more severe, he suggests, than the 2008 financial crisis. So key insight here is the interconnectedness he sees between trade, debt, and, well, global financial stability.
Wow. That's a pretty serious outlook. He also had some specific thoughts on the tariff policies we've seen, right?
Yes, he's quite critical of those. He believes they actually worsen economic instability.
How so?
Well, he sees them as creating friction in international trade, which can then have a ripple effect, leading to negative economic consequences. So for Dalio, trade policy isn't just about tariffs. It's about broader economic stability,
Gotcha. And he mentioned a specific level for the U.S. deficit that he thinks is important, like a threshold.
Exactly. He believes the U.S. federal deficit needs to be below 3% of GDP.
Okay, why 3%? Why is that important?
Because exceeding that level, in his view, creates an imbalance in the supply and demand for government debt, which could potentially lead to issues financing that debt or even maybe contributing to inflation. That 3% mark is a threshold he sees as kind of crucial for maintaining fiscal health.
Okay, so for Dalio, the big takeaways are concerns about trade disruptions, the growing U.S. debt, the fragility of the global monetary system, and the negative impact of tariffs, all linked to needing a more controlled federal deficit.
That seems to be the core of it, yeah.
Now, Steve Cohen from Point 72 also seems to have some worries about the coming year. What's his perspective?
Cohen is anticipating a slowdown in the U.S. economy, particularly in the latter half of 2025.
The slowdown, okay.
He's also expecting a significant correction in the market. So while he might not be predicting a total meltdown, maybe, he definitely sees some challenges on the horizon.
A significant correction that suggests he thinks the market might be a bit overvalued or, due for a reset.
Could be. And what's driving his concerns? Well, similar to Dalio, tariffs are a major concern for Cohen.
Another one worried about tariffs.
Yep. He views them as essentially a tax that ends up increasing prices for both consumers and businesses. Simple as that.
Right.
He's also worried about the impact of stricter immigration policies.
Oh, interesting. Why?
Believing they will reduce the available workforce and ultimately hinder economic growth. So for Cohen, both trade and labor force issues are key factors.
Right. A smaller labor pool can definitely impact productivity and overall growth. That makes sense. And I recall something about him being skeptical about significant government spending cuts, like maybe too much.
Yes. He specifically mentioned Elon Musk's push for government efficiency and potential spending cuts. He suggested that while efficiency is generally a good thing, overly drastic cuts could actually harm the economy.
So it's a balance.
His point is that there's a balance to be struck, yeah.
Okay. So for Cohen, we're looking at tariffs acting as a price increase, a potentially shrinking labor market due to immigration restrictions, and a caution against maybe overly aggressive government spending cuts.
Seems like it.
Now, Bill Ackman also weighed in on this, and his comments sounded quite dramatic, didn't they?
He did. Very strong concern about tariffs. He went as far as to say they could lead to an economic nuclear winter.
Wow. Economic nuclear winter.
Yeah. This really underscores how seriously some major investors view the potential negative consequences of these trade policies. It's a recurring theme, isn't it? This risk from tariffs.
Definitely. That paints a stark picture. Okay, so we've heard some pretty significant concerns from these investors, Dalio, Cohen, Ackman, but not everyone is feeling quite so pessimistic, right? Ken Fisher has a more positive outlook.
That's right. Ken Fisher of Fisher Investments is notably more optimistic. A different tune altogether.
What's he forecasting?
He's predicting a strong global stock market return. Get this, over 20% in 2025.
Over 20%. That's a huge difference from economic nuclear winter.
Massive difference. It's a significant divergence from the more cautious views we've just heard.
What's leading him to this more bullish prediction? What's his reasoning?
He believes that the market might be underestimating the fundamental strength of the global economy. And interestingly, he also suggests that European markets might actually perform better than U.S. markets in 2025.
European markets outperforming the U.S. That's an interesting call.
It is. So Fisher sees underlying strength and potential in specific international markets, maybe ones people are overlooking.
And he mentioned the IMF in his analysis, didn't he? How does that fit in?
He did. He referenced the International Monetary Fund's global growth forecast, which was 3.2% at the time he mentioned it, as part of his reasoning for a positive outlook, suggesting that this level of growth could support strong market returns.
Okay. So we have a real split here among the big individual investors, Dalio, Cohen, and Ackman, with significant worries, especially around trade. While Fisher sees a strong global market ahead, even pointing to Europe.
It really highlights the uncertainty, doesn't it? And the different ways these experts are interpreting the same basic information.
Absolutely. And that's where looking at the broader institutional outlooks can be helpful. They often provide a more data-driven and, comprehensive perspective.
Good point. Let's start with the IMF then. What are their main concerns for 2025?
Well, they've actually lowered their global GDP growth forecast for 2025. It's now down to 2.8%.
Oh, okay. So even they are anticipating a bit of a slowdown compared to earlier expectations.
Seems so. And they've specifically highlighted an increased risk of a U.S. recession, which suggests a general expectation of slower global economic activity overall.
So what's the probability they're assigning to that U.S. recession risk now? Do they give a number?
They've increased it to 40%. And crucially, they directly link that increased risk to tariff policy.
There it is again, tariffs.
Once again, those trade barriers are a major point of concern at the institutional level. The IMF clearly sees a tangible risk from current trade policies.
It really seems to be a consistent theme across many of these analyses. What else did the IMF highlight? Any other key points?
They anticipate that these high tariffs, along with the uncertainty they create, will negatively impact overall economic activity and disrupt the smooth functioning of global supply chains.
Makes sense. Supply chains are already fragile.
Exactly. They've also lowered their growth forecasts for several key economies, the U.S. down to 1.8%, and they actually break that down, saying 0.4% of that reduction is specifically attributed to tariffs.
Wow, they quantified it.
Yeah. China forecast is down to 4.0%, the Eurozone just 0.8%, that's quite low, and emerging markets at 3.7%. So these are significant downward revisions across the board.
Those downward revisions really paint a picture of a less robust global economy than previously expected. And what's their outlook for global trade itself, if tariffs are the problem?
Well, they've significantly lowered their forecast for global trade growth, down to just 1.7%.
Wow, 1.7%. That's sluggish.
Very sluggish. And on the inflation front, for the U.S., they've actually raised their forecast to 3%. So the IMF's outlook points towards slower growth, increased recession risk in the U.S. tied to tariffs, sluggish global trade, and rising inflation in the U.S.
Not a particularly optimistic picture from the IMF, is it?
Not really, no. Now let's turn to Deloitte's global economic outlook. What are they seeing? Do they echo the IMF?
Deloitte also emphasizes overall uncertainty, even in countries where their general outlook might still be somewhat positive on the surface.
So uncertainty is the key word there, too.
Definitely. They provide a region-by-region breakdown, and some recurring themes definitely emerge. For Canada, their primary concern is the potential impact of U.S. tariffs on their exports, very reliant on the U.S. market.
Right.
For Mexico, it's also the threat of U.S. tariffs, coupled with pressures from their own fiscal deficit. So the key takeaway here is the vulnerability of these close neighbors to U.S. trade policy.
Makes sense. And what about their analysis of Europe? You mentioned the Eurozone forecast from the IMF was pretty low.
Yeah, Deloitte highlights significant economic uncertainty there too, and a weakening in household savings. Germany, in particular, is facing worries about U.S. trade policy and a high degree of economic policy uncertainty.
Germany's a big one.
It is. And notably, their CFO survey, they surveyed chief financial officers, indicated a near-zero willingness to invest. Near zero. Which is a very strong indicator of concern among business leaders there. That lack of investment intention in a major economy like Germany is quite significant. Tells you businesses are really holding back.
Near zero investment willingness.
Yeah.
That really speaks volumes about the level of apprehension in the German business community.
Wow. What about some of the other major European economies in their report? France, Spain.
In France, they're anticipating reduced public spending and a rise in unemployment. Spain is seeing uncertainty limiting business investment, and they're also exposed to potential tariff impacts on their trade in goods with the U.S. So yeah, across Europe, uncertainty and the impact of trade policies are major themes.
Okay. And how do they view the major economies in Asia? China, Japan.
For China, they point to a challenging external environment and the potential for tariffs to negatively affect their exports. Japan is concerned about U.S. trade barriers and broader geopolitical risks.
And Australia.
Down under.
Even Australia, which often shows more economic resilience, is worried about trade tensions and a slowdown in its major trading partners, particularly China.
Right. China's huge for them. So Deloitte's analysis largely aligns with the IMF's concerns regarding trade, uncertainty, and a slowdown in growth, but they provide maybe a more granular view by breaking it down geographically.
Exactly. And that CFO survey in Europe really highlights the practical impact of this uncertainty on actual business decisions, people holding off on spending.
Yeah. We also had a report from FTI Consulting. What was their take? Was it all doom and gloom?
FTI Consulting acknowledged that policy-driven factors, especially U.S. trade policy, are definitely shaping the global economic outlook. No surprise there. However, they also offered a perspective of cautious optimism.
Oh, okay. Cautious optimism.
Yeah, and highlighted the underlying resilience of the global economy. So while they recognize the risks, they suggest the global economy might be better positioned to withstand some of these challenges and maybe some fear. It provides a slightly more balanced view amidst the general concerns.
That's a slightly more encouraging note, at least. And what about the World Economic Forum's coverage of this? Did they add anything new?
They mostly focused on the IMF's views, particularly emphasizing the worry that tariffs could lead to increased inflation and greater instability in global financial markets. So again, the potential for tariffs to have broader negative consequences beyond just trade itself, financial instability.
Right. And we also had a perspective from the Center for American Progress. What was their angle?
Yes, they issued a pretty strong warning. They suggested that the policy proposals outlined in Project 2025, which is a policy agenda from a conservative think tank, could potentially lead to financial disaster. So this represents a more politically charged perspective on potential future policy impacts.
Got it. So we're really seeing a wide spectrum of opinions and concerns from these different institutions and organizations. It paints a complex and somewhat uncertain picture for the future, doesn't it?
Definitely uncertain.
Now let's switch gears slightly and talk about Warren Buffett. He's always worth listening to. He's also been quite vocal recently. What are his main concerns, and maybe more importantly, how is he positioning Berkshire Hathaway? What are his actions telling us?
Buffett has definitely been expressing concerns about what he calls U.S. fiscal foolishness. He's suggesting it could ultimately weaken the U.S. dollar in the long run.
Fiscal foolishness, okay.
He's also noted the presence of what he terms charlatans and promoters in the market, which doesn't exactly inspire confidence. His focus seems to be on the long-term fiscal health of the U.S. and maybe some froth in the markets.
And in response to this uncertainty, he's taken some pretty significant steps with Berkshire Hathaway's holdings, hasn't he? The cash position.
Absolutely. They are currently holding a record high level of cash reserves, a massive $3,345 billion.
3.3 trillion? Did I hear that right?
That's what the reports indicate, yes. A huge amount of capital sitting on the sidelines. And interestingly, this cash position is now larger than their total investment in U.S. stocks.
Wow.
Which is a significant shift in their allocation.
Yeah.
It definitely suggests a cautious stance on current U.S. market valuations, maybe seeing fewer bargains.
That record cash holding is a very telling indicator of his current outlook. A key insight into how a seasoned investor like Buffett is navigating this uncertainty, just holding cash.
It speaks volumes. He also mentioned the significant amount of taxes Berkshire Hathaway paid, right? There was a connection to fiscal policy there.
Yes. In his 2024 letter to shareholders, he highlighted that they paid a record $26.8 billion in taxes that year. And he sort of called on the government to use those funds responsibly, to maintain a stable currency and reduce poverty. So his concern isn't just about market valuations, but also about responsible fiscal management by the government itself.
Right, connecting corporate success back to national well-being.
Yeah.
And how has he been adjusting his investment strategy beyond just holding more cash? Is he buying anything?
He's definitely adopted a more conservative approach overall. He's been reducing Berkshire's investments in U.S. stocks.
Selling U.S. stocks.
Reducing, yeah. And he has been increasing their holdings in Japanese trading companies.
Ah, Japan. Interesting.
He specifically mentioned 5 of them, referring to them as mini Berkshires because they're diversified, and apparently he sees them as having more attractive valuations compared to some U.S. equities right now.
So looking overseas for value.
Seems like it. He also cautioned that even great companies can be poor investments if you overpay for them during market peaks. A classic Buffett warning. This highlights a focus on value and maybe some international diversification right now.
So a move away from potentially richly valued U.S. equities towards more attractively valued international opportunities, particularly in Japan. That's a notable strategic shift reflecting his concerns.
It is. And he always offers advice for individual investors. What's his recent guidance been? Anything new?
His advice remains pretty consistent with his long-term philosophy, doesn't it? Emphasizing fundamental investing and avoiding emotional reactions.
Yeah, pretty much. He recommends maintaining cash flexibility. That ties into his own actions, so you can seize opportunities when the market experiences downturns.
Be ready to pounce.
Exactly. He stresses the importance of investing in financially sound companies with strong long-term growth prospects and sticking to a regular investment plan, resisting the urge to trade frequently based on short-term market noise.
So don't try to time the market.
Right. His core message is about long-term investing in quality businesses. Patience.
And what does he advise against for individual investors? What pitfalls to avoid?
He cautions against investing in assets that offer no real growth potential simply for the perceived safety, like maybe just holding cash indefinitely or buying low-growth bonds when better opportunities exist. You might miss out on wealth-building opportunities over time.
So don't be too conservative, maybe.
Perhaps. And, of course, he always emphasizes taking a long-term perspective and avoiding panic selling during market declines. Staying the course is a key part of his message. Don't let fear drive your decisions.
Solid, time-tested wisdom from a highly respected investor.
Okay, so while we've heard a lot of caution from Dalio, Cohen, the IMF, Deloitte, even Buffett's actions, Ken Fisher and FTI Consulting did offer some slightly more optimistic viewpoints. Can we touch on those potential bright spots again and this idea that the future isn't actually written in stone?
Yes. Absolutely. While the overall sentiment from many sources is, well, cautious, Fisher's forecast of strong global stock market returns, especially his call on Europe, suggests that there could be pockets of opportunity out there.
Right. It's not necessarily uniform gloom everywhere.
Exactly. And FTI Consulting's mention of underlying global economic resilience hints that the situation might not be as dire as some of the more pessimistic predictions suggest. It's just a reminder that there are different potential outcomes. Things could surprise to the upside.
And as we said at the outset, it's impossible to predict the future with absolute certainty. We're dealing with probabilities and potential scenarios, right?
Always. This brings us to the crucial idea of preparedness. Regardless of which of these predictions ultimately comes to pass, the key insight here is that while we can't know the future, we can prepare for different possibilities.
Exactly. So while we can't control the market or tariffs or global events, we can control how we think about and react to different possibilities.
Taking control of what you can control.
Right. That's where this concept of developing thinking scripts for various potential scenarios becomes really important. It's about considering different economic environments, like what if there is a recession? What if inflation stays high? What if growth surprises positively? And having a general framework for how you might respond in each case.
It's about being proactive rather than just reactive in your financial planning. Less panic, more planning.
Precisely. And given the level of uncertainty highlighted by all these different perspectives we've talked about, adopting a cautious and well-thought-out investment approach seems particularly prudent right now.
Caution seems like a reasonable stance, yeah.
Absolutely. Now, before we wrap up, we need to be crystal clear, as always. Neither of us are professional investment advisors.
Nope, not licensed. Not qualified.
We're here to discuss publicly available information, talk through these reports and opinions, and try to make sense of it all.
That's right. The information we've discussed today is strictly for informational purposes only. It should definitely not be considered investment advice.
Please don't take it as advice. It's always essential to do your own thorough research and, ideally, consult with a qualified financial advisor who knows your specific situation before making any investment decisions.
Couldn't agree more. Get personalized advice.
Okay, so to summarize then, we've seen a real mix of concerns from major investors and institutions regarding the economic outlook for 2025. Issues like trade policies, those tariffs again.
Yep, tariffs everywhere.
Increasing debt levels and a potential slowdown in global growth are definitely top of mind for many. But we've also noted some signs of potential optimism, like from Ken Fisher, and a recognition of the global economy's underlying resilience, like from FTI Consulting, and Buffett's focus on long-term value.
It's a mixed bag.
It really is.
Yeah.
Ultimately, understanding these different viewpoints, the pessimistic ones and the optimistic ones, is valuable for you as you consider your own financial path.
And maybe here's a final thought for you, the listener, to consider. Given these diverse perspectives from the experts we've discussed today, the Dalios, the Fishers, the Buffetts, what kind of thinking scripts might you develop for your own financial future?
That's a good question to ponder.
It's a worthwhile exercise, maybe, to do some personal research based on what we've discussed, and think about how different economic scenarios could impact your individual circumstances and plans. Be prepared.